Okay, so I'm going to narrate this $450,000 closing disclosure scenario. And what we have here is a closing date of October 14th. So that is after September 1st, right? So that's going to dictate how we handle the tax proration. We do not yet know if the taxes have been paid or not. We have to read further down into the problem to find that out. Because when the closing happens September 1st or after, there's two scenario possibilities. And it depends on if the taxes have been paid by the seller for the year or not. So we'll just keep going. We'll come back to this later. What I like to do when I'm going down through these problems is when I get to an item like the earnest money or the due diligence money, I'll think, well, who pays for that? Or who gets it counted as a credit? For earnest money, we know that is a buyer credit. The buyer already gave the earnest money. And now here we are at closing. We're trying to fill out the closing disclosure, and we know we need to give a credit to the buyer for $3,000 because they already gave the earnest money away. They already gave it in, so they don't have to give it twice. So it's a buyer credit. Due diligence money of $1,500, that's also a buyer credit. They gave that in the very beginning, and now they get a credit back for that. If we didn't treat it as a buyer credit, they'd be paying it twice, and we know that's not right. The purchase price of $450,000 on the closing disclosure, that purchase price is listed in the buyer debit column. The buyer's got to pay that. It doesn't matter if they're getting a loan or not. We handle that in a different place, but the buyer's paying for the house. The buyer's buying the house, so therefore it's a $450,000 buyer debit, buyer expense. Now, the loan amount. How much is the loan amount? Well, it says loan to value ratio, 90-10. So they're borrowing 90% of the $450,000 purchase price. So we're going to go by each slide. We're going to go through each slide, and you'll see we'll do it together. But just to give you a heads up, we'll need to figure out 90% of $450,000. And whatever 90% of $450,000 is, will be a credit to the buyer's side, right? Because the buyer's getting this loan from the lender. They're going to have to pay it back every month over 30 years. But on the day of closing, it counts as a credit to the buyer's side because the lender's giving that loan to them, that entire loan amount. So 90% of $450,000 is a buyer credit. The loan is at a 4.5% interest rate for 30 years. We're going to use some of that information to calculate the interim interest later. The lender is collecting interim interest. There's a little note for that. So we need to count up how many days are left in the month. And we'll figure out the interim interest. We'll handle that when we get to the slide on how to do that. What you could do though is jot out beside this, interim interest is a debit to the buyer. Interim interest is only the interest the buyer's paying per day for the rest of the days in the month of closing. It has nothing to do with the seller at all. So interim interest is a buyer debit. The lender's charging a 1% origination fee. That's going to be a buyer debit because their lender is charging them a 1% origination fee. So the buyer's paying for it. And the buyer's also prepaying interest, 3 points of discount points. So prepaid interest, another word for that is discount points, 3 discount points. And we know that 1 discount point equals 1% of the loan amount. Therefore, 3 points equals 3% of the loan amount. Property is taxed at 75% of the market value. We'll use that information later. The tax rate is 13 mils. We haven't seen that in a while, but we'll use that later as well. My dog is eating in the background, so please forgive the crunching. The annual taxes have already been paid for the whole year. So now we know what we need to know in order to calculate the the tax proration. It's closing after September 1st. It's on October 14th as a closing. And the taxes have been paid for the whole year. So we will figure out what we need to do when we get to that slide in a little bit. Homeowners insurance for the whole year, $1,250. And homeowner association fee for the whole year, it's $4,800, and it's paid monthly. Then they have a note here: the buyer and seller will each pay their individual fees, and the annual fees will be prorated between the buyer and seller. So, first step, let's set up the escrow accounts. So the escrow deposits, this, as far as how many months the lender is requiring to be collected from the buyer to set up the tax and insurance and HOA fee escrow, that's going to come straight from the lender's instructions. The lender will send closing instructions to the settlement attorney, and in those instructions they will specify how many months they want collected for these various things. In this example, they want the closing attorney to collect 6 months for taxes to set up the tax escrow. They want the attorney to collect 2 months for the homeowners association fees to set up that escrow, and then they want to collect 5 months for homeowner insurance to set up that escrow. So in a little while we'll find out what those taxes, HOA fees, and insurance are, and we will multiply it by 6, 2, and 5 months, and that is our escrow deposit item. The prepaid items, anytime you have a closing, you have to pay the first year homeowners insurance as a premium. You pay for the whole first year on the day of closing. So that's the case here. Some prepaid items: 1 year of homeowner insurance the very first year. After that, these escrow amounts will kick in, and the amount that are collected with each house payment will add up and eventually be enough to pay the homeowner's insurance bill from year 2 through 30, or however long the loan is for. Prepaid item, the other item is the first year of annual taxes. So if they're collecting that, then that would be a line item as well. So the overarching question here, look there on the left: how much will the buyer need to bring to closing? We're going to add up all the buyer's expenses and give credit for the buyer's credits, like earnest money and due diligence money. We'll do that math, and that will give us the figure, the dollar amount that the buyer needs to bring to closing. So let's figure out the loan to value ratio. How much of the sale price is the buyer borrowing? What is the buyer's loan amount going to be? We learned that it's a 90-10 LTV, or a 90% loan to value ratio. So here's the formula with the T circle math formula. The sale price times the loan percentage, or LTV, gives the dollar amount of the loan. So they're purchasing a $450,000 house with a 90% LTV. That's going to be $450,000 there at the bottom times 90%. That means their loan amount is $405,000. So we've got the T math there, as well as a linear algebra equation for those who prefer that. We've color-coded it for you so you can kind of see a little quicker, a little easier where things go. So again, purchase price of $450, take 90% of that, gives us the loan amount, or the LTV, which is 90% of the sale price. And here in the top right, we can see what the buyer needs to bring to closing. We're just going to keep a running tally. The purchase price of $450 was a debit. They're getting a credit for $405, so that means their down payment is $45,000. And so far, the buyer needs to bring to closing the down payment of $45,000. As we add more things to it, we'll eventually get down to the final number that the buyer needs to bring, which will include the down payment and the closing costs. Okay, origination fee. How much is the lender charging the borrower? Well, here's the formula for it. The origination fee equals the loan amount times the percentage of origination fee. And in the problem, it told us that the lender's charging 1% origination fee. We know the loan amount is $405,000 times 1% is $4,050 for the origination fee. So that's going to go here on the upper right. We've got the $45,000 down payment. Now we're going to add the origination fee to that. And let's move on to the discount points, which are also called prepaid interest. And don't forget, on the test, discount points, another word for that is prepaid interest, but another term related to discount points is lender yield. When we see that what the discount points are, that means the lender is yielding that amount. So discount points is lender yield. So how much are these discount points going to be? Well, how many of them are there? We'll find out how many they're paying, multiply that by the loan amount, and that gives us the dollar amount of discount points, or prepaid interest is another word for it. So here it is. They're paying 3 discount points. The loan amount is $405,000. So 3 points is the same thing as 3%. And if you use the 3 and a percent key, it's the same thing as just typing in 0.03. So on your calculator, hitting the number 3 and the percent sign is the exact same thing as not using the percent sign, but instead typing in 0.03. So take 0.03 times 405,000. That gives us the total dollar cost of 3 discount points, which is $12,150. Keeping that on our running tally there on the right, we're adding it to the down payment and the origination fee. Now, the buyer needs to pay for the number of days that are left in the month, including the day of closing. The buyer's paying this interest to their new lender. So we need to figure out the dollars of interest per day and multiply that by the number of days left in the month plus the day of closing, because that buyer's new lender is not going to let them live there for free that first month. So the loan amount times the interest rate is the annual interest. That's step 1. Second, the annual interest divided by the number of days in the year, for you guys, 360 days. That's going to give the dollars of interest per day. Then we count up the day of closing to the end of the month, multiply that by the daily rate. That gives us our interim interest. So, step 1. Those were the steps that we just went over. Now let's plug them in. Determine the annual interest rate. The loan amount, 405, times the interest rate they gave us in the problem of 4.5%. That means in 1 year, the first year, they're paying $18,225 of interest. Now, how much is that per day? $18,225 per year divided by number of days in the year gives us a daily interest amount of $50.63 for every day. Next step, how many days are we talking about? Well, it's closing on the 14th of the month. So 30 days in a month minus 14, because it's the 14th day of the month is the closing. That leaves 16 days. But now we have to add in the day of closing because the buyer has to pay for the day of closing as well when it comes to interim interest. So 17 is the days of closing. 17 times the dollars per day of $50.63 gives us an interim interest charge to the buyer of $860.63. That's a buyer debit of $860.63. Here's what we have so far there on the right, 4 items. So the buyer needs to bring to closing so far these 4 things, which add up to $62,000 and some change. Next thing, we're going to do the prorations. This is where you got to really think about it. So we're going to calculate the homeowner association fees first. Now, not every problem you do is going to have HOA fees, but here's how you do them. When are those HOA fees paid, and are they current? The problem's going to tell you that. Here's our circle math. The monthly HOA fee divided by the number of days equals the daily amount. So we know that the HOA fees are $400 a month. We know that the closing is October 14th. So that daily HOA fee is going to be the $400 a month divided by the 30 days in a month. So it's a $13.33 per day HOA fee. Now, how much needs to be prorated? That it's 30 days in the month. Let's subtract the 14 days, and that leaves 16 days. So $13.33 per day times 16 days equals the prorated amount of $213.33. In other words, we need to take away from somebody $213 and give it to somebody else. And because the seller has already paid for the whole month, they're paid up through the whole month, but they're not owning it for the whole month. We need to give them back some money. We're going to take that $213.33 from the buyer because it's for the day after closing through the end of the month, and we're going to credit it to the seller's side, right? Because the seller has already paid for the whole month, they need to get the second half of the month back. They need to get the part of the month back of HOA fees that the buyer will be living there and owning it. Starts with the day after closing and goes through the end of the month, 30 to the 30th. And that's how we got that number, and that's how we count it on the settlement statement or the closing disclosure. It'll be a debit to the buyer of $213. Now, property taxes. Figure out the annual dollars in taxes. We multiply the tax value times the tax rate. And what we have is a purchase price of $450, and they tell us the tax value is 75% of that. So what's 75% of $450? Well, we've done the math there in the bottom for you. 75% of $450,000 is $337.5. That is our assessed value or tax value. Now, the tax rate. I believe it might have given it to us in mils, but here it is in per hundred. Take that $1.30 per hundred. That's the same thing as saying 1.3%. So punch in 1.3 and the percent sign, and that gives us 0.013. We'll multiply that by the tax value of $337.5, and our annual taxes per year are $4387.50. Now, let's take that, figure it out per day. But here's the total formula. Here's the whole 1, 2, 3 steps. Let's look at it here. We've got to determine the daily taxes. We know the yearly taxes are $4387.50. Divide it by what to get the daily? 360 days in a year. So $12.18 per day. Now, have the taxes been paid yet? I forgot. Let's see. Let's keep going. I just forgot. I think they have been paid, actually. So how many are the yeah, that's it. Taxes have been paid. So let's add up the seller's days. How many days did the seller own it this year? Up to and including October 14th. So there on the left side, we've got 30 days all the way from January through September, 30 days each, plus 14 more days in October. A total of 284 days that the seller owned the property, which leaves 76 days that the buyer is going to be owning the property. So from January 1st to the closing date, in red there in the middle of the page, those are the seller's days, 284 days. So let's determine that prorated amount. We've got the $12.18 per day. On the left, the seller's days are 284. That gives us a seller amount of $3461.25. That's how much the seller is responsible for. So, okay, what we're doing here is showing you the two possibilities. Whether the seller has paid for the whole year or not is going to depend on what we do next. On the left side is if the seller has already paid the whole year's taxes. Don't look at the right side yet, just the left side. So if the taxes have already been paid by the seller for the whole year, again, we need to give them money back. That seller is out of pocket for the buyer's portion of the year's taxes, right? What's the buyer's portion? Let's look at this slide that we just left. On the right there, the buyer's portion is $926.25. In other words, for the 76 days in that year, the buyer will own the property. In just that year's worth of taxes that the buyer is responsible for, $926. So we need to take that amount and take it from the buyer and give it back to the seller. Because again, if the seller's paid for the whole year, we need to give them the dollars of taxes that the buyer's responsible for, because they're out of pocket and we need to give it back to them. Now the buyer owns it and they can just move on with life and keep paying the taxes every year. So we've settled them up for the day of closing for that year. Now that's if the taxes have already been paid. In the event the taxes have not yet been paid, let's look at the right side of the page here. Now you can ignore the left side. If the taxes are unpaid, haven't been paid yet, and the closing is September 1st or after, like here, the closing was October 14th. So we figured out that the buyer's portion from October 15th, day after closing, all the way through the end of the year is $926.25. And then that meant the seller's portion is $3461.25. So when the taxes are unpaid and closing September 1st or after, each side pays for their own portion. Buyer is going to be debited their $926, seller will be debited their $3461. So let's see. Yep, this pretty much says the same thing we just saw. We're debiting the buyer. So here's what we have so far. All of those: down payment, origination, discount points, interim interest, and then the prorated HOA and prorated taxes. Now we're going to set up the escrow accounts so that every year when that lender has collected every month's worth of taxes and insurance, they're putting them in this escrow account. We've got to pad that escrow account with a few months. So the lender's building up those funds in that account so that the money is available to be used to pay. We know that we know what the annual amounts are. They give it to us in the problem. If we know the annual amounts, anytime we're trying to solve for escrow, we're going to use monthly. We're going to divide by 12 because we need to know how much per month, because we're calculating how many months are being collected. So it told us in the problem that the lender will escrow 6 months of property taxes. And what's in parentheses on this page is the year's worth of these amounts. So just as an easy point of reference for you, the lender is requiring that the attorney collect 5 months of insurance. Well, we also know that it's $1,250 per year for insurance, and the lender is going to collect 2 months of HOA fees, and we are told that HOA costs $4,800 per year. So the first step is to use these annual amounts there on the right side and determine the monthly. We know the annual. Let's divide each of those big numbers by 12 to determine what they are per month. So taxes of $4387.50 per year are $365 per month, because per year divided by 12 months is per month. The insurance, which is $1,250 per year divided by 12, they're right there in the middle, at the bottom, is $104 and some change per month. And then HOA fees, which are $4,800 per year, convert down to $400 per month. That must be a pretty nice neighborhood. Now we're going to determine that escrow fee. We have the per month amounts at the bottom, and now we're just going to multiply them by the number of months that the lender is requiring that are collected. So property taxes, $365 a month, collecting 6 months worth, so that is $21.93 and 78 cents to establish the tax escrow account. The insurance per month is $104. The lender wants us to collect 5 months to establish the insurance escrow account. That's a total of $520.83. And then the HOA of per month is $400, and the lender wants us to collect 2 months of HOA dues to set up that HOA escrow account. So we're going to debit to the buyer these dollar amounts. So we've added those escrows there at the bottom. Now the prepaids, the lender is requiring, we already set up the escrow accounts for taxes, insurance, and HOA. Now there are a couple of items that are going to show up twice. 2 different versions of insurance, 2 different places on the settlement statement for taxes, and 2 different places for HOA. So here's the second place those things are going to show up. The lender's going to collect the whole first year of homeowners association fees. So there's going to be just a debit to the buyer for the entire $4,800 to pay the first year's HOA fee. Lender's also going to collect the first year of insurance premium. So that's a straight up buyer debit to the buyer for the entire $1,250. And we have that showing there at the bottom. So you'll see we've got 2 places where insurance showed up. Escrows for insurance, meaning however many months they require to set up the escrow account, and prepaying the whole first year of insurance. And the same thing for HOA. We've escrowed $800 for the HOA account, but then we're also having that buyer prepay the whole first year's HOA fees. The only thing we've left out is the credits for earnest money and due diligence fee. So to find out what that buyer needs to bring to closing, we've added up in white all of those expenses. Now we need to subtract out in green the 2 credits that they are getting. Now, what is the buyer's total monthly payment? This is just an extra credit thing. Sorry, I'll get that amount for you when I see you on Thursday. But now, this is just an extra credit thing. Principal, interest, taxes, and insurance. What is that total monthly payment? Well, we know that to calculate the principal and interest, we just need a loan amount and the factor chart. In unit 15 is that factor chart. So for a 30-year loan at 4.5% interest, the loan factor is $5.07. In other words, on that loan factor chart on page 412 of your yellow book, if we look on the chart at 4.5% and move our finger over to the last column at the 30-year loan, according to that chart, if you borrow $1,000, for every $1,000 on your loan, you're going to be paying $5.07 for principal and interest. $5.07 per thousand, because the chart is written up in thousands. Well, this loan on this problem is $405,000. There's 405 thousands. If we had a $1,000 bill, for every $1,000 of loan, there would be 405 of those bills. Okay, so take that principal and interest, divide it by the loan factor, that gives you the loan amount. Well, we have the opposite. We need to figure out the principal and interest. Therefore, we know our loan amount of $405,000. We know our loan factor of 5.07. Let's plug them in. That gives us a principal and interest payment per month. Borrowing $405,000, 4.5% rate for 30 years is a principal and interest payment of $2,053.35. Don't forget to take that loan factor and divide it by 1,000, or you could divide either one. You could either divide the loan factor by 1,000, or you could divide the price by 1,000. Same thing, but I usually will divide the price by 1,000. So we have our monthly taxes of $365.63. We figured that out earlier when we were doing the escrows. We took the annual taxes and divided by 12 to get our monthly taxes. We got our monthly insurance the same way. Those add up to $469 a month just for the T and the I. So let's add the T and the I with this previous slide. The T and the I plus the 2,053 P and I. And we end up with with $25,23.15 as our principal, interest, taxes, and insurance amount. $25,23.15 for PITI. So let's take this a little step further and think about last week when we did some of this math. Here's another example of how much did the buyer pay towards principal in the first monthly payment. So that principal and interest with a loan factor of 5.07 came out to be $2,053.35. The annual interest for the year is $18,225. Let's take that $18,225 for the year, divide it by 12. That gives us $15,1875. That's how much monthly interest we're paying. When we take our annual interest in dollars of $18,225 divided by 12 months, that gives us our monthly interest in dollars. Now, let's take that monthly interest in dollars, subtract it from the monthly P and I. And that's going to leave us with the monthly principal that we paid that first month. Let's subtract that monthly principal from the loan balance of $405. And after the first payment, where we paid $534.60 in principal, we have a loan balance after the first month's payment of $404,465.40. Now, one last thing. Let's do this whole thing again. This last two slides again, but instead of using $405,000 for the loan balance, we're going to use $404,465. The reason we're doing that is we want to know what the loan balance is after the second payment. We just figured out that after the first payment, the loan balance has become $404,465. We need to figure out the loan balance after the second payment. We would not subtract another $534 because that number is going to change. So, breakdown. We've got our $25,23.15. Let's take our new second month's loan balance of $404,465. I'm going to subtract $536 this time because halfway down the page there, the $404,465 times 0.045, which is that interest rate. That gives us our annual interest in dollars. Divide the $18,294 annually. Divide that by the number of months. Leaves us with $1,516 monthly. And that's the interest. So principal and interest of $20.53 minus the interest only leaves us a new principal amount for the second month that's paid of $536.61. Subtract that from the $404, and that leaves us with the third month's loan balance of $403,928.79. Probably aren't going to have to go this far for the PSI, but that's just how you do it. And if the next question was how much is the loan balance after the third payment, then we do this whole thing again, except we use $403,928 as the loan amount. So there we are again, and that's it. That is our sample problem at $450,000. We will talk about it next time I see you, and if you have questions, just let me know.